Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 piece by piece, so you can understand exactly how they think. Today we're looking at a strategy called Cradle Zone Reclaim. It's a trend-following continuation system built around a classic idea known as the EMA cradle, which is the price zone that sits between a fast-moving average and a slow-moving average. Over the next few minutes, I'll walk you through what the cradle is, how this expert advisor decides when to enter and exit, and how it manages risk. Remember, this is educational content only, not financial advice. Let's get into it. So what does Cradle Zone Reclaim actually do? At its heart, this is a continuation strategy. It does not try to predict tops or bottoms, and it never trades against the prevailing trend. Instead, it waits for an existing trend to catch its breath and then looks to join it on the pullback. The tool that defines the trend is a pair of exponential moving averages. One is fast, with a default length of 8, and one is slow, with a default length of 21. The space between those two lines is what traders call the cradle. In a healthy uptrend, the fast line sits above the slow line. Both lines slope upward, and price rides above them. In a downtrend, everything is mirrored. The strategy is watching for the moment price dips back down into that cradle zone and then pushes away from it again in the direction of the trend. That shallow pullback, followed by a reclaim of the fast-moving average, is the setup this expert advisor is designed to detect. It uses a third indicator, the average true range, purely as a measuring stick. The average true range gauges recent volatility, and the strategy uses it to confirm that the slow line is genuinely sloping, to size the stop buffer, and to decide when to lock and break even. Who is this style suited for in an educational sense? It's aimed at traders who prefer to follow established trends rather than fight them, and who like the structure of buying a dip or selling a rally with a clearly defined, relatively tight stop. The default design has trending currency majors or metals in mind, on time frames from 30 minutes up to 4 hours, though the time frame is never hard-coded. As always, trading carries real risk, and losses are a normal part of any approach. Nothing here is a promise of any particular outcome. Let's walk through the logic in plain English. Everything starts with a regime gate, and this gate is strict. For an uptrend, the strategy requires 3 things at once. The fast EMA must be above the slow EMA. The slow EMA must be rising by at least a minimum amount per bar measured in average true range units, and the fast EMA must also be rising. A downtrend is the exact mirror. If none of these conditions hold, the strategy simply does nothing. That single rule is why it never takes a counter-trend position. Once an uptrend regime is confirmed, the strategy examines the candle that just closed. For a long setup, 3 conditions must line up. First, the candle's low must reach down into the cradle, meaning its low dipped to or below the fast EMA. Second, that same low must stay at or above the slow EMA, so the floor of the cradle was not broken. And third, the candle must close bullishly back above the fast EMA. When all 3 agree, the strategy enters a buy at the ask price. If price had closed the cradle out by breaking the slow EMA, the setup is rejected outright. That rejection filter is the main reason drawdown stays contained, because it only ever takes continuations where the trend structure is still intact. The short side is completely symmetric. In a confirmed downtrend, the just closed candle's high must reach up into the cradle. Its high must stay at or below the slow EMA, so the ceiling holds, and it must close bearishly back below the fast EMA. When those align, the strategy enters a sell at the bid. Now for risk management. The stop is structural. On a long, it sits just below the slow EMA, buffered by a fraction of the average true range. Because the entry hugs the fast EMA, the distance to that stop is naturally small. The take profit is set as a reward to risk multiple, with a default of 2.2, so the occasional trend winner can pay for the many small scratches. There's also a break-even lock. Once price advances a set amount in your favor, the stop is pulled up to the entry price, so a renewed pullback can no longer turn a good position into a loss. Finally, there's a regime exit. If the fast EMA crosses back through the slow EMA, the trend premise is gone and the position is closed immediately. And only one position is ever open at a time, with no averaging down. Let's read through the actual meta editor code. At the top are the inputs you can tune: FastEma and SlowEma. defaulting to 8 and 21, define the two edges of the cradle. ATR period, defaulting to 14, sets the volatility window. SlopeAtrMin controls how steeply the slow line must be sloping to count as a trend. Stop buffer ATR sets how far beyond the SlowEma the stop sits. Reward ratio is the 2.2 take profit multiple, and BreakevenAtr decides when the stop is pulled to break even. Now the long block. Notice it only proceeds when up regime is true and the candle is bullish. The last low must be at or below the FastEma, so the wick reached into the cradle. That same low must be at or above the SlowEma, so the floor held. And the last close must be above the FastEma. When all of that is satisfied, entry is taken at the ask. The stop is placed just below the SlowEma using the ATR buffer. The risk is the distance from entry to stop, and the take profit is that risk multiplied by the reward ratio. Then trade.by sends the order. The short block is a perfect mirror. It requires down regime and a bearish candle, the high tagging the cradle from below, the SlowEma ceiling holding, and a close back below the FastEma. Entry is at the bid. The stop sits just above the SlowEma, and trade.sell places the order with the same reward to risk logic. Let's bring this to life on the chart. On screen, you can see two lines drawn over the candles. The gold line is the FastEma, and the blue line is the SlowEma. The space between them is the cradle. Watch how they behave together as the story unfolds. At the far left, price is climbing. The gold FastEma is sitting above the blue SlowEma, and both lines are angling upward. That's exactly the uptrend regime the strategy demands, so the gate is open for long setups only. On the third candle, notice what happens. Price dips lower, and the candle's lower wick pushes down into the cradle, reaching the FastEma. But look carefully. The wick does not break below the blue SlowEma. The floor of the cradle holds. Then the candle closes back up, bullishly, above the gold FastEma. That is the precise moment the strategy has been waiting for, and you can see the buy entry marker appear on that candle. The pullback tagged the cradle, the floor held, and the FastEma was reclaimed, all in one bar. Now think about where the protective stop would sit. It's placed just below the blue SlowEma, buffered by a fraction of the average true range. Because the entry hugs the FastEma and the stop sits just under the slow line, the distance between them is small. That's the tight, structural risk this approach is built around. From there, watch price run. Candle 4 pushes up, candle 5 extends, and by candle 6 price has stretched well above both moving averages and reaches the take profit marker. That target was set as a reward to risk multiple, defaulting to 2.2, meaning the reward aimed for is a little over twice the initial risk. One clean continuation like this is the kind of move the strategy relies on to cover its smaller losing trades. Along the way, once price advanced far enough, the break-even lock would have pulled the stop up to the entry, removing the original risk from the trade. Now the character of the market changes. After that peak, price rolls over. Follow the two lines. The gold FastEma turns down and crosses below the blue SlowEma, and both begin sloping lower. The regime has flipped. The strategy now closes its long premise and switches to watching for short setups only. It will not try to buy this falling market. Watch candle 11. After several down candles, price stages a shallow bounce, a pullback rally against the new downtrend. The candle's upper wick reaches up into the cradle and touches the FastEma from below, but crucially it stays under the blue SlowEma. The ceiling of the cradle holds. Then the candle closes back down, bearishly, beneath the FastEma. That is the mirror image of the long setup, and the sell entry marker appears right there. The rally tagged the cradle, the ceiling held, and the FastEma was lost again. For this short, the stop would sit just above the blue SlowEma, once more keeping the risk defined and compact. From the sell entry, price continues lower through candles 12 and 13, and by candle 14 it reaches the short take profit marker, again aiming for that reward to risk multiple. Notice the symmetry. The long and the short use the identical logic in opposite directions, always in the direction of the prevailing trend, and always with the cradle floor or ceiling defining the risk. That structure, entering only intact trends and cutting the trade the moment the cradle collapses, is the whole idea behind this approach. So there you have it, a full walk through Cradle Zone Reclaim. We covered how the two exponential moving averages form the cradle zone, how the strategy only trades in the direction of a confirmed and sloping trend, and how it enters on a shallow pullback that tags the cradle and then reclaims the FastEma. We also looked at its structural stop just beyond the slow line, its reward to risk target, the break-even lock, and the regime exit that closes a trade when the cradle collapses. Remember, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling me which strategy you'd like me to examine next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.